Hey, what's up, everyone? Thanks for tuning in to another episode of Fun Facts About Real Estate with me, Brian White, a realtor here in Phoenix, Arizona. So today I wanted to talk to you guys about refinancing and PMI, or private mortgage insurance. So many people I talk to when it comes to purchasing a home and they've never purchased before, they want to come up with 20% down because they've probably read like Dave Ramsey's book, Money Makeover, or just have talked to their parents. Their parents advise them to have 20% down to make sure that they don't have to pay an extra couple $100 a month that really doesn't go anywhere. So private mortgage insurance is essentially a tax on those who have a mortgage to protect the lender in the case or the event of defaulting on the loan. So the problem with the game plan of purchasing with 20% down payment is if you want to buy a home that's $200,000, you need to have $40,000 down payment today, plus the $6,000 to $8,000 that it costs in closing costs to purchase the home. Now, that's not necessarily a realistic or attainable goal for everyone, and if it were, then it would take people a heck of a lot longer to purchase. So there are other ways to purchase a home. You can purchase a home with as little as 3 to 5% down payment. So this is definitely more beneficial. It's the way that I went about purchasing my home. I'm going to refer to my property and how I purchased my home for this story and education to help put it into context. So when I purchased my home, I did a 5% down conventional loan. And the reason why I did that is because it gives me a little bit more flexibility and freedom as it pertains to refinancing, or this hack that I'm talking to you guys about today. So I call it a hack because I don't feel like it's common knowledge. There's a lot of people that I've spoken with that had purchased a home in either 2011, 12, or 13 and really capitalized on super low interest rates in the low threes, which is incredible because today it's 4.5 to 5 or above depending on your current credit scenario. So they are sitting here now multiple years later, and they're still paying their private mortgage insurance. PMI is what I'm going to say from now on. I'm just going to refer to it PMI. They're continuing to pay it when they really don't have to, especially in the current status of the Phoenix marketplace here in Arizona. So the thing is that with me, for example, since I purchased the home, I put a new roof on it, and thankfully I did it myself thanks to the help, experience, and wherewithal knowledge of my brother and my dad, who helped me put it on ourselves. So I've made an improvement to the home. I'll circle back as to why making an improvement is something that's beneficial for a spin-off of the same thing. So when I purchased my home almost 2 years ago, and because I did a conventional loan with 5% down, as soon as I get to my 2-year mark of owning my home, I can and am eligible to dropping my PMI. So the only way in which I can drop my PMI is if I have 20% equity in the home's value based off today's market value. But let me be clear here. My main thing is that I don't want to refinance. Most people don't want to refinance because they've got these great low interest rates, and they don't want to refinance to get rid of that PMI because then they'll be subject to these higher interest rates. So what I'm going to do when it comes to the week of my 2-year mark, I'm going to call up my mortgage company who's holding my mortgage and say, hey, I'd like to reevaluate my property value so that I can drop my mortgage insurance. For me, it's about $135 a month that I'm paying on my PMI. So the way in which it's going to happen as far as the scenario played out is I'm going to call them, I'm going to say what I want to do, and what I'll have to do is I will have to get my own appraisal done, which here in Arizona is going to cost me between $400 and $500 to get my own appraisal, and they're going to report that appraisal back to the mortgage company. So I bought the home here. Thankfully, here in Arizona, we've been seeing pretty steady appreciation the last many years in a row, and today it's worth here. If that difference is 20% equity in today's market value, I will be eligible to drop that mortgage insurance and start saving myself $135 a month. Granted, it did cost me a couple $100 out of pocket to get this option available, but in 3 or 4 months, I've already recouped that money, and now I'm saving every single month thereafter. So definitely something that most people think, because I'm gonna still keep the interest rate that I got back in 2017, which is definitely better than it is today. So with respects to, hey, let's just say I wanted to not wait the 2 years. There are restrictions here. I'll reiterate right now that I'm not a mortgage lender. I'm not the expert in this category. I'm just really bringing the topic up for conversation so that you can explore your options with your mortgage lender. So let's just say I did the same thing, my conventional loan, and I didn't want to wait to the 2-year mark. If I have made a significant improvement to the home and it's before the 2-year mark, instead of that 20% equity, I have to have at least 25% equity. So I have to have more value added into the home or more equity in the home. So if you fix things that are broken, that's not making significant improvements. If your water heater goes out and you replace it, that's not a significant improvement. Your AC goes out, you fix it, that's not a significant improvement. But if you put a new roof on the house, you completely remodel the kitchen and bathrooms or whatever, those are things that are considered significant improvements on the home. So you have to be able to prove that you have made those improvements and then go through the exact same process that I originally described. Call them up, get an appraisal done, they report back, and it's worth at least 25%, you got it. I can drop that mortgage insurance sooner than the 2-year mark. I do know that if you do a first-time home buyer down payment assistance grant, there are definitely different restrictions to this strategy, and I think the parameters are definitely different and you have to wait longer. But for the sake of the argument, I use my house as an example because I can relate to it most specifically. So that's it. You can, in fact, drop your mortgage insurance without refinancing your home. I hope that you guys learned something today. And if you did, please comment below if you have any questions, feedback, want some resources for local mortgage lenders in the Phoenix Valley area. I'm happy to help you achieve your home ownership and home refinancing goals or non-refinancing goals. If you've made it this far, I thank you so much for being here. When it comes to real estate, I hope you think of B.